Hello everyone! Traditionally, the goal of the project manager is to complete a project on schedule and within the budget. The job responsibilities of project manager are expanding in today's dynamic climate. Project managers need to be more financially astute as firms grow more project based. Projects must not only be finished on schedule and under budget, but they must also increase the value of the company for its shareholders and its long term financial success. Project managers will need to have a deeper understanding of the company's cash cycle and how each project fits into it in order to approach projects as ventures. I am Tanay Purohit and let's dive deep into the importance of the finance in project management. The optimum way to understand the importance is by getting to know the interaction of the two domains, finance and project management. Savvy? Attention here. We are heading to the financial life cycle of a project. Phase 1. Project launch. An initiation marks the start of every endeavor. When someone, a group, or an organization wants something done, they start a project. This could involve anything from creating software to building a bridge. Projects begin with ideas, but that's not all. They require money. There are various ways to fund a project. Cash. Having the necessary funds on hand to pay for the project is an easy concept. Loans. The project owner takes out additional loans to pay. This can come from a bank loan, a loan from a private lender, or a government loan. Loans have to be repaid, of course. Grants. The owner is given money by an institution like the government, a foundation, or a charity. Grants, as opposed to loans, don't require repayment. Meeting the initiating requirements are must. Money is a must, but what good of money if you don't know how to manage it well? That's where finance comes in handy. The initiating step also involves budget formation. Want to know more about that? Check out our another video, 7 steps to creating and managing a project budget. Phase 2. The initiator looks for companies to do the work. The project owner can start looking for contractors, consultants, and other companies once money has been secured. The most qualified companies should be the ones chosen. To gauge a company's qualification, consider the following financial factors. First, credit. This is the preferred indicator for assessing a company's financial readiness. Credit is an indicator of a person's history of on-time bill payment and fiscal responsibility. Second, bond rating. Much like a credit rating, bonds are assigned based on a company's track record of sound financial management. Bonds are a type of surety. When a firm obtains one for a project, the agency is effectively promising to step in and finance the project in the event that the company that purchased the bond defaults. A corporation will pay for less bond if it is more financially reliable because they are less likely to actually default. Revenue. How much money does a specific company make annually? From a financial standpoint, a company with annual revenue of $10 million would seem less reliable than one with annual revenue of $50 million. Correct? Phase 3. Contractual hire of firms. Once an owner chooses the companies to engage in their project, they formally contract with these companies, binding them to do the work. At this point, you should be familiar with the following financial terms. Contract value. The owner and contractor have, in one way or another, agreed to carry out the task for a specific sum of money. The contract value is that amount. Penalties. also referred to as damages, are imposed when a contractor doesn't fulfill their obligations under the terms of the contract. Payment schedule, also known as a schedule of values of unit pricing. This document specifies how much will be paid to the company after they have finished a specific number of jobs or an amount of work. Savvy? Savvy. Now that reminds me of something. I guess it does the same for you as well. Quickly scroll down in the comment section and tell me what am I referring to. It is time for phase 4. As work is completed, progress payments are released. It's natural to talk about being paid when addressing the use of finance in project management, and we are correct to do so. Despite being the most crucial phase of the project, there isn't much to say about it. That's when payments are released. The owner shall promptly distribute payment to the contractors on the project once work is finished. The timing and quantity of payments will differ greatly amongst projects. The most crucial factors are a transparent payment schedule, appropriate work performance, and prompt payment release in accordance with the contract. Firms account for their own costs, revenue, and profit in phase 5. Firms working on a project will now really understand how well it is going for them. Accounting is the focus of this stage. The accounting phase of a project is comprised of the terms and procedures further in the video. Although some are relatively simple, they are nonetheless included to give the whole picture of this phase. Costs. How much has a business so far paid to complete the work? How much revenue has been generated as a result of payments? What expenses does the company have that aren't directly related to a particular project but are still necessary to operate? This comprises an office, staff members, workers, insurance, etc. Cost to complete, also referred to as estimate to complete, estimate at completion, or budget at completion. A cost to complete estimate enables us to take into account the project's performance, progress, revenue, and cost to date and forecast the project's future revenue, budget, and profitability. Total revenue. This is estimated by deducting the project expenses from the project's revenue. Overhead costs are not taken into account. Net profit, also referred to as operating profit. The net profit is what is actually left over after all expenses, including overhead, have been covered. An accrual allows a business to record expenses and revenues for which it expects to expend cash or receive cash, respectively, in a future period. Conversely, a deferral refers to the delay in recognition of an accounting transaction. Let's understand them better with examples. From a supplier, Joy Electronics bought some goods. The merchandise was delivered this month. However, the $300 related invoice was not. The company's accountant enters a $500 accrual to reflect the related liability in the current month. Additionally, Joy receives a $10,000 invoice that includes an advance rent payment for a storage facility for the following year. Its accountant enters a deferral to postpone $11,000 in expense recognition to upcoming months so that the expense recognition is in line with facility utilization. Before we head on, let me introduce you to love, empathy, and project management. The book discusses how to have an empathetic relationship with your team, not just telling them what to do, but also how to accomplish it. The link is in the description. There comes the final phase. Drum roll! After completion, firms are left with a profit. Hopefully, they are left with a profit. The project is finished at this point. costs have been covered and all payments have been received. The company will have money left over once all costs, including overhead, have been covered in the project was financially successful. This is regarded as net profit or operating profit as was previously stated. While a percentage of this net profit should be undoubtedly distributed as bonuses to the company's workers, if the company wants to expand and flourish in the future, the majority must be used for the following purposes. First, expansion. This involves increasing the number of employees, relocating to a bigger office, making significant acquisition for the company, etc. Second, maintenance. In a business, there will always be continuous expenses. This covers both updating technology and replacing outdated equipment when it wears out. Profit can also be reinvested back into the company. While maintenance and expansion are examples of reinvestment, this can also take the shape of employee training and education races, etc. Now, I guess we are clear about the importance, aren't we? Finance is inseparable from project management. From budgeting to execution, paying for staff, sharing profit, it's right in there. So, this is it for today. And don't forget to like, share, and subscribe. Click on that bell icon, and we'll meet soon. Till then, bye bye. And in the meantime, go watch other videos as well. I'll look for that jar of dirt.